My name is Kathleen or Kat. This is Eddie, and we are advisors at Skye Wealth. And we're kind of just going to talk today about understanding personal insurances, looking at things you might not know, and kind of also going through a case study as well. So you can kind of learn a bit more about how personal insurances work. So we do have a poll in the chat at the moment. So if you can kind of just give us an idea of like what your situation is, like do you already have personal insurances? Are you currently in the process of getting it, or do you not have any insurances at all? So that will just give us an idea of like where everyone is coming from. So I can see already we've got, so 40% of people already have insurances, 20% are in the process of getting it, and 40% don't have it at all. So it's kind of an even split between all three. So I'm going to go to the next slide. And I should also add, like, this is a collaborative session. So if you have any questions at all, please chuck them in the chat and we'll answer them towards the end of the presentation. And we might also find that some of the questions are also answered while we're going through the presentation as well. So I'm going to go to the next slide. And this is kind of, we always have to put this disclaimer when we're talking about anything which might be considered advice. So there's no actual advice in here to your personal circumstances. You actually need to have a written advice document in order to do that. So this is kind of just here. So it's just telling you it's general information that we've provided to you, and you really should go see a financial advisor, either one of us or another financial advisor, to discuss your personal situation as well. Okay, so just a brief overview of the agenda that we have today. So we'll start off by talking through what the different types of personal insurances are. We'll also talk about how we at Skye assess your insurance needs, because they're unique to every person. We'll also look at what tips we have for choosing the right insurance and also the right insurer for you, because again, that does change from person to person. It's not a one fit all situation for everybody. Next, we'll look at when should you actually look at reviewing your insurances. 15 we'll go through is what are the most common causes of insurance claims, and we'll go through some interesting stats about that. We'll also talk about some pitfalls you should avoid when we're considering personal insurances. We'll also do a brief comparison of insurances inside super versus outside super, and also group insurance versus retail insurance. So brief little overview here. Group insurance is what you have inside a super fund like Australian Super, Hester, etc., while retail insurance is what you get through a financial advisor like us. We'll also go through some common misconceptions to do with personal insurances. We'll look at a common question we get is, can loadings or exclusions be removed? We'll finish with a couple of case studies, and then we'll go through any questions that you may have as well. So yeah, as we're going along, if you have any questions at all, please feel free to type them into the chat and we'll answer them all at the end of the presentation. Okay, so I will hand over to you now, Eddie.
Thanks, Kat, and good evening, everyone. Thanks for joining the webinar. So we're just going to go through a little bit about understanding personal insurance, the different types of policies and cover. So we'll just move on to the next slide. So there's 5 types of cover that we tend to look at, which we'll briefly touch on here. So it's life or death cover, total and permanent disablement, which is sometimes referred to as TPD, trauma cover, income protection, and child cover. So we'll have a bit of a dive into what each one is. So life insurance obviously pays a lump sum benefit if you pass away or you're diagnosed with a terminal illness. Now, the proceeds tend to be used for things like paying off debt or replacing the income of your family. Obviously, if someone passes away, we want to make sure that essentially there's some income there for the remaining spouse and to look after any dependent children. The next one is total and permanent disability. So that simply pays a lump sum if you are totally and permanently disabled and you won't be returning to work again. Funds usually for TPD or total and permanent disablement for medical expenses. So it is difficult to determine exactly how much you're going to need to cover medical expenses, but usually there's a provision there to cover rehab expenses, alterations to the car or the home. We also look at replacing some lost income, because if you're permanently disabled, you probably won't be going back to work, and obviously covering off on debts as well. Income protection, that pays a monthly benefit if you're unable to work because of an illness or an injury. The maximum we can get from most insurers is 70% of your salary. There's no insurer that pays you 100% of your income, because if they did, there'd be no incentive for you to go back to work. So it's all capped at about 70%. And then with income protection, there is a waiting period. So they usually range from 30 days, 60 days, 90 days, all the way through to 2 years. And there's also a benefit period, which is basically how long you can claim for. It's either 2 years, 5 years, or up to the age of 65. The major thing we're looking at there is making sure that we replace your income, simply because you'll probably still have living expenses and mortgage repayments to make. Next slide. Trauma insurance, that basically pays a lump sum if you are diagnosed with a serious illness. Now, most insurers will cover between 30 and 40 medical conditions. The vast majority of claims that we see revolve around cancer, heart attack, stroke, and musculoskeletal issues. Coverage for that is usually to cover medical expenses. So we know that private health, Medicare cover a lot of things, but there are a lot of things that can still be an out-of-pocket cost, like alternative therapies, traveling to and from places overseas, travel for treatment, and we also top up a little bit of income replacement as well. The last one is child insurance, or what we call child trauma insurance. So that's essentially a lump sum if your child is diagnosed with a serious illness. So cancers, deafness, neurological condition, severe burns, major head traumas. And the reason we recommend this is simply because for most parents who have children, if their child does have a critical illness, they're probably going to take some time off work to look after the child. We do make a portion of the cover available for medical expenses, but essentially what we're trying to do is just alleviate the financial stress, so that if anything was to happen to the child, the parent will receive some sort of a payment to be able to stay home and look after that child. Next slide. Okay, so what is personal insurance used for? As you can see from this slide, there's a few things that it does cover. All of the insurances that we just spoke about will kind of dip in and out of these 4 areas. So for example, for life insurance, we'll be looking at having some funds there for the people that you depend on. For total and permanent disability, you'll probably have medical costs, living expenses to cover, paying bills. For income protection, similar sort of thing, covering living expenses and paying bills. And for trauma cover, same sort of thing again. So basically, funds paid from insurance can intertwine with each other, and it all depends on the situation that you're in at that point.
Okay, so I'll touch on assessing your insurance needs, and I did just want to quickly touch on Kat. It's kind of weird for me to say that name because I'm also Kat, but I did see that you were just quickly asking, does this include through super? So we will be talking about personal insurance instead of just inside super as well, and we'll kind of talk about the differences between having insurances just inside super versus outside super, and also having, say, insurances inside a HESTA or Australian super fund compared to insurances you'll get through an advisor as well. So that will be covered in this as well. Okay, so let's go on to, oh, you're also a Kathleen, awesome. Okay, so some major things we would need to look at if something were to happen to you. So the first probably big thing is if you were ill or injured and you couldn't work, it's your income, because you're obviously very heavily reliant on your income to be able to pay for your bills, pay your mortgage or your rent, meet your future goals, things like that. So that's one of the biggest key things that we look at. We also look at what would medical costs possibly be. And unfortunately, we can't really have a definite number that we can give for everyone, because unfortunately we don't know what's actually caused you to stop working or what illness you may have. But we kind of give estimate an amount that might be a decent amount to cover what private health insurance or Medicare might not. Debts is also another big one. So we would definitely look at the mortgage of the home that you're living in, or if you are renting, maybe if you were no longer able to work, you don't want to still be dealing with renting and having to move every 12 months. So maybe we'll also include a provision for you to be able to purchase a home if you couldn't work again. We also look at, well, if something were to happen to you and you were in a couple, will your partner have to now make up for your lost income because now they're having to deal with paying for the rent, expenses, mortgage on their own? Maybe you've got children as well. So now we also need to consider, well, looking after the children, education costs, things like that. And then finally, there's also tax on insurances that we need to consider. So in terms of TPD or total and permanent disability insurance and income protection insurance, there is normally tax on that. With life insurance, there's only tax payable if it's not paid to a particular type of person. So if you are a spouse of someone who's passed away, or if you're a child, then there's generally no tax. But if you were just like a friend, then that normally gets tax. Otherwise, there's no tax if it's paid to, child, partner. And then with trauma insurance, that's a little bit different. There's no tax on trauma insurance at all. So I'll explain those a bit more thoroughly. So we also look at tips for choosing the right insurance and the right insurer. So one thing that people might think is, one thing that some of you might have tried to do is you've thought, I'll try and increase my insurance through my insurer, through my super fund. And the thing is, you're only getting one insurer's perspective, because say with Australian Super, for example, their insurer is TAL. So you're only getting one insurer's perspective on your health, your occupation, things like that. So that's one of the things that going to an advisor can unlock some more options, because you'll actually be getting the opinions of different insurers in terms of how they can assess you. So what insurers will look at, and what we look at as well, is we look at, do you have any pre-existing health conditions? Would they possibly result in any exclusions where, say, for example, you have an issue with your left wrist? That might mean you have a left wrist exclusion for your income protection and your TPD insurance. We also look at family history of health. So certain health conditions which can be considered hereditary may actually impact how the insurer assesses offering insurance to you as well. We look at occupations. So occupations like mine and Eddie's, where we're kind of white collar, we just sit at a desk all day. There's not really many concerns about that. We don't really have any issues with getting insurance based on occupation. But other occupations where they may be more risky will have more limitations with who will be willing to offer cover. So say, for example, things like people that work in mines or police officers, for example. So that's another big component there. We also look at age. So some insurers will actually be better for certain ages than other insurers in terms of how their premiums are priced. We also look at the level of cover. So this will vary completely from one person to another, because one person might have a mortgage, another person might have their home fully paid off, another person has children, the other person doesn't. So this all varies from person to person. And then we also look at the length of time that you'll likely need the insurances. And this actually structures how we choose what type of premium you'll have. Because if you're young, we might look at what is called a level premium, where you're paying more now, but they shouldn't go up as much over time. While if you're maybe age 40 or over, you probably wouldn't benefit from a level premium anymore. So that at that stage, we look at stepped premiums for you instead. Okay. So when should you look at reviewing your insurances? So these are the big things that you need to look at when you need to say, do I need to look at changing my insurances? So the big one is life changes. So this is kind of a broad category, but I just guess anything that's mean, a big change in your situation where it's kind of covered in some of these areas. I'll try and think if there's like a specific one I could think for that category. But change of career. So if you go from being a farmer to an accountant, probably worth looking at reviewing your insurances, because an accountant also has an easier time of getting insurances compared to a farmer. Also, you might be able to change or get a better premium rate on your insurances as well. Policy anniversaries. So with the insurances that we recommend, about 30 to 60 days before your policy renews each year, you can actually, if you've had a significant life event happen like these, so you've had either a promotion, you've taken out a new debt, or you've had a child, for example, you can actually, with most insurers, you can increase your cover automatically by a certain percentage without necessarily need to go through medical underwriting. So that's always a good time to kind of check in, just in case you've had any big changes where you might actually benefit from those automatic increases. Definitely with any increase or decrease in your debt, that's definitely a good time to review your cover, because with how we assess how much life insurance and TPD insurance you need, that large component of that is based on debt. And even if you say we start off with insuring you for your $500,000 mortgage, that's not going to stay the same, because obviously you're paying that down. So you can look to decrease that cover over time. While at the same time, if you decided, I'm going to upgrade my home and purchase a $1 million home, that means you might actually need to increase your cover to make sure that that new full debt is covered as well. Change in family situations. I kind of just did briefly mention that before. So if you do have a child, maybe you might need to look at increasing your cover so that if something were to happen to you, if you were to pass away, you know that there's still your income being provided for that child ongoing for maybe a period of 10 years or more, so that the other parent doesn't need to worry about trying to increase their work hours while you're no longer with us. And yeah, any increases or decreases in income. So with increases, that simply means you'll be able to get more income protection, because income protection is based on the percentage of your salary. And if you had a permanent decrease in income, maybe you might want to look at decreasing your income protection, for example, as well, because with income protection claims, they do look at what has your income been in the last 12 months. And if your income has decreased, that might mean that the amount that you're insured for will be less than what it might be reduced if you were actually earning less. So any big changes in your income, it is worth coming to us as well, just to make sure that your income protection is covering you for the right level of income as well. Okay.
All right, we're going to touch on some of the most common claims that we see across the different types of insurances. So we'll go to the next slide, Kat. All right, so for life insurance, we've broken this table up into male and female. We've also got up to the age of 35 and then from age 46 to 55. Obviously, from a life insurance perspective, as you can see, cancer does make up a lot of the claims for both males and females past that age 46 mark. Cardiovascular is quite surprising. We've got females under 35 at 37% almost.
Yep, biggest life insurance claims.
Yeah, males post 46 at 25. So obviously we can see that cancer is quite a large area claim there. I think the next one is total and permanent disablement.
Oh, it's critical illness.
Critical illness?
Yeah.
Critical illness, again, as you can see from the top two, both males and females, the biggest area claimed is cancer. Surprisingly, for males, it's 63% below the age of 35. And females above 46 years of age, it's almost 80%. We've then got cardiovascular again for males. Accident and injury drops off a bit for females, but the major one there again is the diagnosis of cancers for both male and female.
Yeah. So the number one cause of claims for critical illness insurance, which is trauma insurance. So just to give a brief recap on this pays out a lump sum if you are diagnosed with a serious illness. And as you can see here, cancer is the most common cause of claims for that. And the two other most common causes are heart attacks and strokes as well. Before we go to the next slide, which is talking about claim statistics for income protection insurance, I kind of want to do a bit of a quiz. So we've actually got one of these books that we're giving away. So some of you might have found us through what's now called the Money website. It's had multiple name changes. So Glenn James did this book. It's really good, would highly recommend. So I'm going to do a quiz and we're going to see whoever gets the closest will win a copy of this book as well. So what I'm going to, we'll ask for some chat, see if anyone wants to type into the chat. In terms of income protection claims, so with income protection insurance, just a brief recap on what Eddie mentioned at the start. So that pays out a monthly benefit if you can't work due to illness or injury. So my question to you is, with the male group up to age 35, what do we think is the most common cause of claims? That's my first question to you. So if anyone wants to type in the chat, otherwise I'll ask what my question for the quiz will be. I'll give it like a moment. Tool's saying injury. I'm not just saying critical illness. So cardio. Imelda, can you repeat the question? So for the age group of up to 35 for males, what do we think is the most common cause of claims? And it's one of these categories here. So it could be cancer, cardiovascular, accident, injury, nervous system. We've got a few. So we've got three people mentioning accidents. Three people mentioning accidents. Yeah.
Looking at the percentage, Kat.
Yeah. So, okay. So my question to win the book, it is accidents. Actually, accidents is the most common cause of claims in males up to age 35. What percentage of claims were due to accidents? Before I go to the next slide, whoever gets the closest answer will win a copy of the book. We've got 80%. I'm not sure if one of you wants to change your answer a bit, just so you're not both at the same one. All right, we've got a 70. I'll give it a little bit longer. Got a 75. 85, yep. Okay. I'll do a countdown from 5 to 1, and then I'll move on to the next slide. All right, so 5, 4. Oh, sorry, Stephanie, your kiddo was distracting. Totally get it. That's fine. So question is, for males up to age 35, the most common cause of claims is accidents and injuries. What percentage do we think that is? That's my question. So whoever gets the closest percentage, they'll win a copy of this book. So if you can take a stab. Yep. Okay, cool. I think people are changing their answers now. So I'm going to go with what your most recent answer is. Well, we'll go to the next slide. We'll stop it there. Okay. So the answer is 72.4%. So the reason for this is that, as you might have realized, young males can be pretty stupid and they do stupid things, and they're more likely to hurt themselves, unfortunately. So who had the closest one in the most recent numbers?
I think it was Imelda.
Imelda. Yep. Okay, Imelda, you win a copy of this book. So if I'm just wondering, how do we get those details? So if you can maybe put in, just saying. Okay, so one of my colleagues is going to email you, so that is all good. We'll get your details and we'll be able to send you a copy of that book. Cool. All right, I'll hand it over back to you, Eddie.
All right. So as we just saw, accident injury make up the biggest percentage for males, also for females as well. So
up to age 35, we can be pretty silly as well. So
yeah,
but not as silly as the guys. Yeah.
It's actually a question I get a lot when I speak to clients about, what can I claim on my income protection? And my response is always, you're more than likely going to claim either via accident or injury, and then illness after that. So we can see from those stats that, accident and injury make up a lot of claims for both males and females. I think we're on to total and permanent disability. Yes. Okay. Funnily enough, accidents and injury are quite prevalent in males again, up to age 35 and then 46 to 55. So obviously I haven't learnt our lesson.
No, unfortunately.
Cancer for females, 46 to 55 at about 29%. And then surprisingly, mental health or mental and behavioural at 33.3% for females up to the age of 35. So there's some pretty big stats there as well.
Yeah. So yeah, it seems like a common theme is that for women, cancer is like a bigger issue in terms of TPD insurance, and also or with income protection as well. And then with men, it's like accidents, injuries, definitely. And then for the females, up to age 35, mental health is a big one as well. Yeah. So some of the things to think about of what could be the reason that you would claim upon these insurances. Okay. So let's go to pitfalls to avoid. So the first of these is getting your insurance from TV ads or the meerkats. I'm sure everyone has seen the compare the market ads on TV talking about how you just go to a website and you can plug in some details and you can look at what's the best insurance policy for you. So I do know they do life insurance as well. With the compare the market website, for example, you're only getting very limited type of insurance. So you're generally getting direct insurance, and they don't have as many benefits and features as what we call retail insurance, which is what you can get through an advisor. You may find that the insurer names there look similar. So I believe TAL, AIA, you can get insurances with them directly, but those insurances don't have as many benefits and features as if you went through an advisor to get them. So I know I have had a client recently that did have a direct AIA income protection policy, for example, and that one only had like a 1-year benefit period for income protection, which is good for, I guess, if you can't work for 1 year, but if you still can't work beyond 1 year, you're kind of stuffed. It's not really that helpful. So ideally, speak to an advisor. That would be the best way to go about doing it. Second common pitfall is say I'll get to it in the future. I was kind of guilty of this myself, even though I shouldn't be, because I'm an insurance advisor. I only really did a full review of my insurances last year when I started working at Skye. But I've just been lucky that I haven't had any issues in my health that have happened where I've needed to make a claim. Well, I've had clients even younger than me that I've possibly needed to make a claim now. So it's one of those things where you're like, I don't think it'll happen to me, but unfortunately, we don't have a crystal ball. None of these things you ever want to happen to you. And at least, if you already have the insurances there, you don't need to worry. You've got that thing to fall back on if you were to become ill or you were to become injured. Look at the green one now. So only increasing your insurances within your super without seeing if there's a better insurer out there for you. So I was kind of alluding to this before, where you can increase your insurance in super. That's better than maybe not doing anything with your insurances at all. But you're only getting the view of one insurer. So if you were declined for increasing your cover inside super, that doesn't mean that you can't get insurances at all. There may be another insurer that may be willing to offer you cover, or maybe it's just based on that insurer doesn't offer cover for your occupation. All insurers differ with how they offer insurances to particular occupations, also for particular health conditions as well. So coming to an advisor, we'll be able to do the work to see which insurer is the best one for you based on your own personal situation. Go around to the left. So not taking out any cover at all because it's too expensive. So this is a common probably one of the most common things I have people say during an advice meeting is, I didn't know that so much of it could be paid through super. So I think people think that, oh, if they're going to an advisor, all your insurance is going to be paid out of pocket. No, that's not how we do it. We actually still structure your life and the bulk of your TPD insurance to be paid within super. It's only trauma you always have to pay outside of super. And an income protection can be either inside, outside, or kind of a combination of both. So don't think that, oh, if I'm going to an advisor, that means I'm going to have all these extra premiums that I'm paying. You'll find that most of the time, most of it will actually still be paid through your super fund. The last one we've got here is setting your insurance and forgetting about it for years to come. So you can have big changes that happen in your life. So as I mentioned, having a kid, buying a house, changes in income. With insurances, it's not a set and forget thing. Any big changes that happen in your life, you should look up reviewing your insurances, because one, you might be underinsured and then you go to make a claim and you're like, oh, why didn't I review this sooner? Now I've got all these extra debts, or I've got kids that I need to worry about. I didn't really think about that before. Or you might have actually been able to reduce your cover and be paying less in premiums, but because you've just left it, then you've been just paying extra premiums for cover you might not necessarily need. So it's something that you should review at least every few years, I would say. Yeah. Okay.
All right. I might touch on the inside super versus outside super. So if we can just go to the next slide. So obviously insurances inside super and outside super have their positives and negatives. So having insurance inside super, there's always good and bad. So we'll go through a few of those. From the good perspective, less impact on cash flow. So it just means that it's not an out-of-pocket expense to yourself. Now, depending on your situation, that might be more applicable at a certain point in life. If you have just one person working, or you've had children and you're trying to save money, or one partner's not working, which is good. So you can have most of it paid through your super fund. Obviously, one of the negatives is it does impact on your retirement savings. So if you have them coming out of your super fund for a long period of time, you may have your account balance going backwards or breaking even. There's obviously strategies there for you to be able to put additional money into superannuation, but that's another topic altogether. Another good thing of having it inside super is it can be cost effective based on default amounts. So when people join super funds, the super fund will give you a level of cover, might be based on units or it might be based on age, and it covers life, total and permanent disability, and there might be some income protection in there. That can have its benefits. If someone has some health issues, you've got some default cover already in that account. The one thing that's a bit of a disadvantage is if you then go back and decide that you want additional cover, what we usually find is that it's often more expensive when you increase that cover through a group insurance policy or your super insurances. Most of the time it ends up being a case that the retail offering provided by other insurers in the market may end up being actually cheaper and provide more comprehensive cover. Another good thing is default, so limited or no underwriting. Obviously, when you join, they will give you a certain amount. They don't really ask you any medical questions. That can have its positives and negatives. One of the negatives is that potentially at claim time, they may actually underwrite you at claim time. So without fully disclosing your medical history, you're leaving yourself a little bit open because it might give the super insurer not a way out, but obviously there's ways that they can maybe look at things a little bit differently. One other thing to consider under the bad section is at claim time, conditions of release to get that money out may be a little bit more difficult. And also if you have, for example, a total and permanent disability payment paid out of your super fund prior to the age of 60, there's likely to be some tax implications in there as well. Okay. Also, super-linked policies. So as Kat said, we can have most of your insurances paid through super. but then we would have certain things that can't be paid through super linked to those policies. Okay. Terms and conditions and limitations. So what we tend to find with a lot of these policies is they can be quite restrictive. Some of the larger industry funds, for example, in the event of a claim, they may not pay you your income protection and your total and permanent disability cover. They may pay one of the two. So there could be some limitations in those contracts. And obviously, insurance inside super, you can't have any trauma cover in there, as Kat mentioned. That's something that needs to be paid from your own cash flow. Touching on group versus retail insurance. Have a look at that slide. So group insurance is the typical insurance that you get through your super fund. Retail insurance is what we tend to deal in. Insurance options. So under group insurance, there really is only one insurer. As Kat said, if you've got Australian super, your insurer is TAL. So there's not too many alternatives there. And based on your medical history, TAL may be one of the insurers that may exclude a particular condition or not cover you at all. When we look at retail insurance, we have 10 plus insurers. So that gives us a broad range to be able to go out to the market and compare what's available based on your medical situation. Now, we may get differing results between insurers. Our role is to try and get you the most appropriate cover. That doesn't always mean it's the cheapest, but at least we can go out to market and have a look at those 10 insurers versus just the one that's out there. Payment flexibility. So cover is linked to the super fund. You can't add trauma cover. You can't add child trauma cover. The other thing to consider under the group insurance is that if you decide to move your super fund, you won't be able to take your insurances with you. So those insurances will cancel. Under retail insurance, we can use any retail insurance company, still have your premiums paid from your super fund. The beauty of the retail contract is that it's actually portable. So if you move from super fund A to super fund C, you can do that and it doesn't affect your insurances. Can the policy change? So yes, with group insurance, most super funds will have one insurer, and after a number of years, they may go out to tender and see if there's any other insurer that's happy to offer cover at a cheaper rate. They do have the discretion to change your insurances at any point, whether it be up or down. They may include some additional restrictions, so you don't really have a say on the policies within group insurance. With retail insurance, the policy cannot be changed. So once that policy is in force, as long as you keep paying the premiums, that insurer cannot cancel that contract on you. And the cost, yes, it's complicated with group insurance. They use units, and units are based on levels of cover. They have their wonderful, funky calculators. And retail insurance can be a little bit the same sometimes, but most of the time it is complicated, but probably not as complicated as group insurance.
All right, so I'm going to touch on some common misconceptions with personal insurances. So myth number one, the only way to pay for premiums via super is to apply directly with that fund. So we were kind of just, Eddie and I were just kind of touching on this just before. So you can actually go through an advisor, have insurances taken out through a retail insurance policy, but have the majority of premiums taken from your nominated super fund. So this is an incorrect myth. Just because you're going through an advisor doesn't mean that you're not paying insurances through your super fund anymore. We can actually go to any retail insurer and choose your nominated super fund to take those premiums from. So that way, the insurances aren't tied to your particular super fund. And as Eddie mentioned before, you can change super funds in the future, and you can still keep that insurance. From the insurer's perspective, you just need to let them know who the new super fund is, and they'll just know, okay, next year we'll take the premiums from that new super fund instead. So it's quite portable and quite easy to do. Myth number two, so insurance companies never pay out claims. So this is definitely not true. You can actually look at the claim statistics yourself on the Money Smart website. So it shows you, it compares claims paid out just through, I believe it's group or super fund insurance, also versus insurances that are placed by an advisor. And you can see how the different insurance companies rank compared to each other in terms of the claims submitted, how many of them are accepted. And it's quite a high percentage. It's not low at all. Insurers don't try to avoid paying claims. They do want to pay you out the money. They want you to be able to use what you've taken out the policy for. What you might see people complaining about is, say, they go to make an income protection claim when they were off work for 1 week. Now, the minimum income protection waiting period for pretty much most policies out there is at least 30 days. If you're only not working for 1 week, that's not an income protection claim. So that's not the insurer's fault. You just haven't actually paid attention to the terms of your contract. And going through an advisor will be able to help you with knowing, well, okay, you've had an illness, you've had an injury, is this a claimable event? We'll help you with seeing if that can be claimed upon as well. Okay. Myth number 3. So the cover I can see in my super fund will remain the same. So again, Eddie just touched on this before. Unfortunately, the insurances that you have inside super, the terms and conditions of those can be changed at any time. The most common thing that I've noticed the super funds tend to be changing more recently is the TPD insurances, because they're finding that that's being one of the most expensive types of insurances that they're paying out if people do make a successful claim. So they're kind of removing things from the policies to make it harder to claim as time goes on. And I do know that because I also have an Australian super TPD policy, which I have kept because I don't have any exclusions on that insurance. But I do know that over time, the TPD definition has actually worsened over time because they're trying to keep the premiums affordable, and the only way to do that is to strip features out of the insurances. While if you take out a retail insurance policy through an advisor, once you have the policy in place, as Eddie mentioned before, they can't make any changes to it. It's what's called guaranteed renewable, where they can't take away any benefits and features once you have the policy in place, and as long as you're paying the premiums. The only thing they can actually do to the policy is add features to it. They can't take features away. So the only thing you'll ever see with a retail insurance policy is upgrades, never downgrades like you have with group insurances inside your super funds. Okay.
I might touch on, can a loading or an exclusion be removed? So the answer is sometimes yes and sometimes no. So they can be reviewed with regards to your health improving. So we'll start off with smoker rates. So with smokers, obviously they pay much higher premiums than non-smokers. One thing to consider there is that if you are a smoker and you become a non-smoker and you can stop smoking or vaping for 12 months, you can have your premiums converted to non-smoker rates. Quite an easy process. It's just a form to complete. But please make sure that you've done the 12-month period before you decide to change that. And not only will you save money on the cigarettes and the vaping, but you'll also find that your premiums probably drop by 30 to 40% as well. So moving on to usually when you have been symptom or treatment free for a period of time, most of the claims that we see will be exclusions on mental health and back. The insurer may put a time limit on it. So they may come back to us and say, look, we're not happy to review this unless there is no ongoing symptoms or treatment. After that period of 3, 4, or 5 years, feel free to come back to us and we can have a look at it. I've actually seen exclusions applicable just for 6 months. So depending on what the situation is, they can range from 6 months right through to 5 years. BMI or body mass index, which is your height and your weight. If you do lose weight, the insurers will want to make sure that you have kept it off for a period of 12 months. They're not big fans of the yo-yo diets. So if there has been a bit of a loading or an increase in your premium because of your body mass index, and you lose weight, you need to kind of keep that off for at least 12 months.
Yeah.
Family history. So your age at application can have an impact based on your family history. So what we're talking about here is that some of the exclusions that we see for critical illness or trauma cover are usually around breast cancer, simply because there's some family history where the mum or the sister has had breast cancer as well. So let's say mum had breast cancer at 45 and you're applying at the age of 44. It's likely that the insurer may put an exclusion on there because of that age, but obviously after a period of time and passing that age, there's nothing stopping us from going back and having that reviewed as well.
Cool. All right, so let's talk about some case studies. So these are some examples of claims that we've actually had with our own clients. So the first case study I'm going to go through is a breast cancer claim. So we had a female client who was single, age 34. And so she discovered that she had breast cancer, and she actually needed not full time off work, but she did need to take some time off of work to undergo treatment and attend doctor's appointments while still being able to work part-time. So what you might think is like, oh, well, that means she can't get income protection. No, she actually was still able to get income protection. And this is another key difference of group insurance or insurances you might have inside your existing super fund compared to retail insurances. Because she had a retail income protection policy that she took out with us, she could make a partial claim. So even though she was still working, she didn't get her full income protection monthly benefit that she was insured for, but she did get a proportion of that to supplement her part-time income until she was able to go back to work full-time. So she ended up getting a total of $48,000 paid out over 6 months. And then she was also able to make a trauma claim. So again, trauma, you just need a diagnosis of a serious illness. You don't even need to have stopped working. So if she didn't stop working at all, she wouldn't be eligible for the income protection insurance, but she still would have been able to make a trauma claim. So she had $187,000 paid out to her as a lump sum payment. And this was also able to help her, so fund her treatment, also help with funding her part-time work as well, in addition to the income protection. And it was also able to allow her to bring her mum over from New Zealand for support and to look after her while she was going through treatment as well. So 34, I'm currently 35, so she's younger than me. And yeah, she had to go through this big scare, but because she had these insurances in place, it wasn't a big financial burden on her. And she was also able to get her mom to come be with her while she was going through this tough time as well. So that's one example that we have there. And the next one, so this is actually our most recent claim that we've had. So we have a male, age 33, who's married with a $500,000 mortgage, and he made a claim for renal cancer carcinoma. So he was paid out just under $186,000, and he did need surgery to remove the cancer, and he spent more than a week in hospital and did note that he had a very slow recovery. But with that trauma insurance, that allowed him to fast track having the surgery and also to just allow him to take some time off of work as well, so that he didn't need to worry about still paying off the mortgage or leaving it to his partner to deal with the mortgage on their own. Like, he had the trauma claim, and that just alleviated a lot of financial stress for them as well. Okay, so conclusion. Discussion time. Now, is this the same as Q&A? I'm just trying to think.
I think so.
I think it is. I'm just like, is there another slide for Q&A, or am I missing something here? I think we are up for Q&A now. So I'm going to check what questions that we do have. So we do have a question from Stephanie. So is income protection still offered for contractors? So daily rate fixed term contracts. So it depends. So it depends on the insurer. I can kind of I'm going through this situation at the moment where only about a week or two ago, I actually had a prospective person call me saying that they are a contracts nurse. I hadn't even heard of this before. So they will do contracts in hospitals, might go for like 6 months at a time. They'll move around the country. So they don't really have a fixed location that they live in. They'll kind of just go where the contracts are. And they were like, well, the main thing that we're looking at getting is income protection. That's the most important thing. So I thought, let me try and ask generally around the insurers what their thoughts are. And in their case, there ended up being 2 insurers that were willing to offer cover for their situation, while the other insurers said no. So that's why I said it kind of depends. If you have one insurer might say no, and it will depend. They'll ask, what they will do is they'll ask us additional questions regarding the nature of your contract. So how long is one of the big things that they look at is how long is the contract for? How long have you been working in that type of role? If you've already been in that profession for a long time, which is what a couple of the insurers said about this nursing client, then they didn't really have a concern, because it's like, well, you do have a long-term history of working as a nurse. So even though you're doing contract work, that's fine, because again, nurses are also very in high demand as well. So you can always put the question to us. We can always check with the insurers. And that's part of the big background research that we do when we are preparing the advice for you to determine which insurer is the best one for you as well. Okay.
I think we've got a question from Atul. What is the tax impact or difference for income protection for the 2 options, inside super and outside super?
Yeah.
So I'm not sure, Atul, but I think you might be talking about what's deductible within super and outside of super. So obviously, if your income protection is paid from your super fund, there is a tax deduction that they receive of 15%. Obviously, if you own that policy yourself and you pay the premiums yourself, you can actually claim those premiums as a tax deduction each year at your marginal tax rate.
Yeah, so generally, quickly, income protection is more beneficial to own yourself, because your marginal tax rate is generally higher than what's inside super, which is only 15%, but you have to pay for the premium up front before you get the tax deduction at claim time. So it's just a comparison of which one you prefer, but both you still get the tax benefit from.
And I think it's also important to look at your financial circumstances at that point.
Yeah, definitely.
I've got a client at the moment who has 1 child, and now they're expecting another, which ended up being twins. He said cash flow is really important to him, and he's on a good income, but still prefers to pay it from super just to be able to save on that cash flow.
Which is totally fine. And the good thing about that too is he can start having it inside super, and then it's very easy to move it outside super in the future, and he doesn't need to go through underwriting again to do that. So he can just put it through super now to kind of save on some cash flow to deal with the arrival of the twins, and then in the future, if they're a bit more stable, the mom's at work as well, he can put it outside super. That's very easy to do. Yeah. Okay. Now we have this question: what is the role of Skye Wealth after a person takes insurance policy? Will there be any assistance at claim time if need be, or the person has to deal with the insurer directly? We help you with claims as well. So we actually have a section on our website. We have 3 sections where people can book in a call. So the first is for brand new clients, if you just want to have a discussion with us to see if we're the right fit for you. All free call, there's no obligation there. We also have 2 sections for existing clients. So one of them is review. So for any client that has existing insurances and they want to review their policies, like as I mentioned before, if you've had a change in your income, if you've had a change in your debt, any changes you might want to make to your policies, you book in a call, we can help you with making those changes. We do also have a 3rd option on our website where you can book in a call if you think that you might need to make a claim. And even if you have any doubts about whether you do have a claim or not, I'd still recommend going through that form just so we can actually check to see whether you do currently have a claimable event or whether it's just a matter of time of needing to wait maybe a little bit more before you do go and lodge a claim. But we will assist you with that. You don't need to deal with the insurer directly, because the last thing we want you to do is, if you've been diagnosed with an illness or you've had an injury, we don't want you to be having to deal with the insurer on your own. We will assist you with that. Yeah.
Question from M. Am I able to choose which advisor to talk to?
Yep. Well, okay. So when you book in a call, I was going to say yes, but I was like, actually, no. So when you book in a call via our website, it does kind of get allocated to us randomly. So I guess you don't get to choose specifically there if you want to speak to someone. You can always have a chat to the person at the time. And if you do feel like you want to speak to someone in particular, you can, but we all work the same way. So there's not really any real benefit of you going to me or to Eddie. We'll all look after you the same way. The only thing I can think of is sometimes if you might have a preference to speak to a female advisor. You've got me, got Azaria. We have a couple of new advisors coming up as well. So we will have some more women on the team shortly. But yeah, in short, you don't get the choice from the beginning, but we would all help you in the same way. Yeah.
From Manoj, in general, how are the year-on-year premium percentage increases across the retail insurers? Okay, so that's a bit of a tricky one. So we don't actually know what the year-on-year premium percentages are. Look, every insurer is different. One thing you need to consider is that with your policy, your levels of cover are indexed to inflation each year. As a result of that, your premium is indexed to inflation each year. Then it will depend on whether you have stepped premiums, which in general are cheaper but do go up as you get older. So the older you get, the higher the premiums become. Or you go level premiums, which are more expensive initially, but are locked in at the age that you applied. But it's very hard to answer what the percentage increase is, because if they're going up with inflation or CPI each year, it may actually depend on what the CPI figure is as well.
Yeah. And then if you've got level, it's not going to necessarily increase as much as stepped. Stepped goes up with each year's age, but then stepped also starts off being a lot less than level to begin with as well. So there's all these different factors that can affect the premiums. If you ever did have any concerns about an upcoming renewal, that's also a reason to book in a review call with us as well, if you did have concerns about fitting those premiums within your budget. But yeah, it's a very difficult question to give you an estimate on what they might be. It's just the same as it is to kind of give you an idea of what premiums might be for you, because again, it depends on your own situation, how much income you're earning, what occupation you have, all these different factors as well. All right. So we have, what are the latest superannuation rules or changes we should know about in terms of insurances, I guess you're asking. So the first thing that does come to mind is that there was I can't remember the technical name for it, but a couple of years ago, so there was pressure to kind of stop people having multiple super funds with multiple insurances, and then the premiums just reducing their total super balance over time. So what did happen is that for anyone that had insurance inside super, people had to opt in to keep the insurances if they had below a certain super balance, I believe. In fact, if they didn't answer that letter, then the super fund had to cancel their insurances. They didn't have any choice, which is, I guess, good from one perspective in that they're not having premiums taken out anymore. But when you come to us as a client, we will look at your insurance that you have inside super, and we won't necessarily say get rid of it. If we are expecting an exclusion on any new retail insurance, while you've got no exclusions on your existing cover, like my own situation, for example, I've got an exclusion on my retail TPD, but I don't have an exclusion on my TPD inside Australian Super, we would recommend you keep that policy you have in Super because you've got no exclusions on that currently. And unfortunately, some people did lose cover that they might not have realized they had, which had no exclusions. So that is something that has happened in recent years. So if you thought a few years ago, I have insurances inside my Super, you might need to just double check that because you might not actually have that anymore. Trying to think, has there been any other big changes in super rules related to insurances, Eddie? I can't think of anything.
Not really.
Yeah.
No.
Yeah, that's a big one, I would say. And I think one thing is, if we do recommend you keep your insurances on that topic, you can actually opt in to your super fund in advance to just let them know, even if you were to say stop working and you weren't having any payments being paid into your super fund by an employer anymore, it just lets super fund know, I don't want to cancel the insurances. So that way they won't just automatically cancel them. So that is something to keep in mind as well. Okay.
Question from Krista. Could you clarify when exactly we should consider reviewing our insurance plans? Anytime, I think. If you've got existing insurances in place, it might be a good time to review. You never know, there might be different providers, different premiums available. But I think we quickly spoke about it before, changes in plans. So changes in jobs, taking on debt, paying off debt, the addition of starting a family, changes in relationship status may result in you needing to review your insurances. So they're probably the big ones that we would be kind of looking at.
Yeah. And you don't feel that, as I did mention before, you can book in a call with an existing client on a website. You don't feel like, oh, I need to have had a major change to book in that call. Even if you just have a question about your policy and you're not sure if something might affect you, we can talk you through that and say, like, yep, okay, maybe you should look at changing it, or no, that's not actually really going to change your insurances. It can be like a 2-minute conversation. That's completely fine. Just if you do feel like you need to possibly look at reviewing a cover, just book in a call. It's quite easy. Yeah. Okay. So next question from Stephanie. Do policies with ongoing payments or income protection stop at a certain age? Or is that company policy specific too? Okay. So it depends on the policy you've taken out. Our default position with income protection is if you can get it based on your occupation, we'll recommend that you have a benefit period to your age 65. And that's generally when payments will stop. So if you can't work and you've got them to age 65, that's when your income protection payments would stop. Now, I did mention it is also based on occupation as well. So for some occupations, the longest benefit you can get for income protection might be 5 years. It might even be 2 years in some cases. So it will depend on your income protection policy itself as to how long those payments go for. I did have this question from another client more recently who I did recommend income protection to age 65, but unfortunately it's a little bit out of his budget. So I said, okay, maybe we'll consider a 5-year income protection benefit period for you. But you just need to keep in mind that you can make multiple claims, but it's kind of from a pool. So if you've got a 5-year benefit period and you make a claim for 12 months and then you go back to work, and then in the future, 5 years down the track, you need to make another claim, that means you've only got 4 more years left to receive those payments for, because you've already received payments for 1 year in total. So yeah, it's more dependent on your policy as for how long those income protection payments go for. But if you have a benefit period to age 65, you can make multiple claims and have payments going up until you turn 65. Yeah. All right, got one more, I think.
I'm just starting out with personal insurance and feeling a little bit confused. What coverage should I definitely consider? That's a good question. So part of our role is to help you work that out. We do what's called a needs analysis, which gives us an idea of the levels of cover that we think you need. And look, it depends on your situation. So if you're single, no dependents, no debts, you may not need life insurance. You may need to concentrate more on covering total and permanent disability and income protection and trauma cover. On the converse side, if you have a partner, married, debt, and 3 children, then you might be looking more at the life insurance, the permanent disability cover. But from our perspective, we give advice on the 4 areas of insurance. You then have the option to say, yes, I'm happy with that. No, I'm not. Can I reduce it? Yes, we can help you through that as well. You may actually wish to remove some of that cover also. So that's what the advice process is about. We're more than happy to take you through various scenarios of where you might be at this particular time, and just kind of guide you along the way. And some cover is always better than no cover. That's what I say.
Yeah, definitely. I'd say, like, for anyone, and I had this going back to that same the same person, like, so he thought, like, I don't feel the income protection is important. Maybe I'll just keep the life, the TPD, and the trauma. I'll take out the income protection because that's the most expensive. And I said, income protection is probably the one I'd least want to take out because you're very highly reliant on your income. So that's how we kind of came to, well, maybe the income protection is too pricey. Let's decrease it to a 5-year benefit period. Keep your life, keep your TPD. Maybe don't consider trauma for now, and then you can add that in the future when you're a bit more stable. He was also having to pay for, he didn't have much inside super, so he was needing to pay for those premiums out of pocket. So he was a bit of a unique scenario in that case. Yep. But once the super balance does grow, then he can possibly look at having that pay through super as well, and then adding the trauma in the future as well. Okay. So follow-up question here. Do any other insurances like TPD or trauma stop at a certain age? So that, again, does depend on the individual insurer's policy. So with TPD, some of them do stop at 65 as well, like same as income protection. Some insurers have them go to age 70, I believe. And then with trauma insurance, it also does depend on the insurer. What's the latest age for trauma? I think it's
usually like 75.
75, yeah. But if you still had trauma at age 70, those premiums would be ridiculous. So I would hope at that point of time you don't really need the trauma anymore. You've probably got enough in your assets that you wouldn't need to still be paying insurance premiums, because the premiums will be quite high at that stage. But yeah, I think age 75 tends to be when trauma stops for most insurers. Yeah. Okay. Do we have any other questions at all? And these have been really good. Thank you so much for giving all those questions to us, everyone. And no question is a silly question. So don't feel like you're asking a silly question. I'm happy to answer any questions. Okay. It doesn't look like having anything going up, so I'm just going to check to see if I missed anything on these websites. No, not really. Okay, so kind of at the end of our presentation, so you can scan this QR code to book an initial call if you would like. Otherwise, the link is available on our website. So at the moment, if you book in a call, you will come through to one of us on the right here. We do also have a couple of associate advisors, which aren't shown here, but you might be speaking to them as well. In most cases, you'll be having an advice meeting with one of us 6 here. And please keep in touch with us on our socials. So we're pretty active on Instagram. We have some funny memes. We're also on Facebook and LinkedIn as well. And yeah, as I mentioned before, can't pick an advisor when you're booking in a call, no. But we're all awesome people. We'll all help you in the same way. So yeah. Oh, I did have another question just pop up. Is retail always more expensive than group? No. So I'd say it's actually the other way around. So group cover tends to be more expensive than retail, 9 times out of 10. There is some cases where group insurance ends up being cheaper. And if that is the case for your situation, we might actually recommend that you keep your group cover instead, or maybe increase that. But most of the time, as soon as you look at increasing your insurances, retail actually ends up being cheaper than group, because group is cheap at your default levels of cover that you have at the beginning. As soon as you start to increase it, those costs go up. And we do if we were replacing your existing, if we were recommending to replace your existing group insurance, we would actually do a comparison in the advice document because we legally do need to do that. And we'll show you the cost difference. So you can see what the cost is at retail versus your group policy. So you'll be able to see, okay, it's cheaper, or okay, maybe it's more expensive, but we'll explain why we've still gone with retail rather than group. Yeah. All right. And we also wanted to mention, if you liked our webinar, we do have another one coming up on the 26th of November. So this is about how to protect your biggest asset, you. The role of personal insurance is in building a strong financial foundation. So this will be held by Phil and Amy. So Amy wasn't mentioned on the previous slide, but she is one of our associates who will actually be an advisor very shortly. So she's one of the new female advisors that we'll have soon. So they'll be doing another webinar on the 26th of November. So if you want to get in touch again, brush up on your knowledge, you can also sign up to that webinar as well. Oh, Diana has a quick question. So if cancer is, sorry, I keep forgetting to actually do this. Everyone can see what.
Me too.
sorry, everyone. So just a quick question. If cancer is in your family history, can cancer be excluded from your policy? If the cancer can be a hereditary one, yes. So breast cancer is one that can be excluded, but it does depend also on what age your family member had it. So yeah, with like,
it's a little bit different with each insurer too.
Yeah, it depends on the insurer. Like, say for example, if your mom would have breast cancer at 40, that's worse than your mom having breast cancer at 60. So it really depends on the age of the parent and what type of cancer it is. It's not all cancers, but it's not all cancers that are considered hereditary as well. And it's not just cancers as well. So things like Parkinson's, that can be considered hereditary, but that also does depend on the age that your parent had the Parkinson's. So it doesn't, like, if you do have a family history, don't think that that means that you're definitely going to have an exclusion. We will do that research and determine if there might be an insurer that will offer you the cover without that exclusion.
And Kat, I think I've come across one where most of the cancer was excluded, but one insurer was happy to put a loading.
Yeah, yep, that can happen too.
So you're covered, but you're paying extra for it.
Yeah, we didn't really cover that. So loading is something where you're still covered for that condition. You're just paying a bit more. So say, for example, a 50% loading, or I'll say 100% loading for easy math. So 100% loading means you're paying 100% more than what the normal premium would be. So essentially you're doubling the premium, but you're covered for that health condition as well. So that is always an option that we can look at. And it's generally what we would recommend in the first instance, because although you're paying more, at least you're also covered for that health condition. And given that you have a loading, I guess you're more at risk of actually developing that condition. But you can always, which I have had in a situation with me as well, if you're like, I'd rather pay less, so I'd rather go with a policy that has an exclusion rather than loading, you can choose to do that as well. Yep. Oh. Okay, so, and we would love to have your feedback as well. So this is another QR code for you to give feedback about how we did tonight. If you have any ideas on how we can improve, please let us know. We just want to make these webinars, we want them to be useful for you, and going forward, we're always trying to find ways to continually improve. So please let us know if you have any feedback. I will try to remember to actually put the questions up so you can actually see what the question is. So that makes it much easier for you. But yeah, any feedback you want to give us at all, we would really appreciate it. So please do so. Cool.
All done.
Yeah. Well, I think we've got, if we don't have any more questions, I will let you all go and enjoy the rest of your Tuesday evenings.